There is a real threat to the Australian property market in 2023, and it's called the mortgage cliff. I'm going to break down exactly what the mortgage cliff means, how bad it can actually get, and what it means for you if you're someone that's actually being held back with the fear of what's about to happen. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. As we go through 2023, you're gonna start hearing mortgage cliff a lot more. It's gonna be spoken about everywhere and it's gonna make for some really dramatic clickbait articles. So getting ahead of things is very key. It was the same thing that I was sort of warning you guys about when it came to the rental crisis 14 to 16 months before it actually started happening. Same thing here is that everyone's gonna start talking about this mortgage cliff and apparently it's gonna pop this bubble that is the Australian property market. But in order for us to really assess this, let's look at some numbers. Let's look at the logic of the graphs and the stats that are provided by the RBA, the ABS, and based on that, we can then conclude what is about to happen and how we can best prepare for it. I know it can get quite lengthy, it can get quite nerdy when I bring out the graphs and the stats, but I'm gonna try and make up for the lack of entertainment that a graph can provide you with my sense of personality. And in order for you to enjoy that, you just gotta smash that like button. So with that, let's jump in. Now there are about $478 billion worth of fixed home loans that are going to come to an end in 2023. Now, contrary to what the mortgage cliff really is, which is effectively that all 478 billion is going to end today, and that's the cliff, it's more about a tiered approach. You see, not everyone took out fixed rates at the exact same time. They bought property throughout the months, and that means that their 2 years or 3 years ends at different times. So it's more like a slope rather than a cliff, okay? So that's very important to understand straight away. When it comes to the psychology of the market, when you're looking at confidence and fear and what people are actually saying, I have a bunch of strategy calls. I talk to so many investors and I talk to first home buyers. And what I'm sensing is a lot of that fear that we saw when the articles were coming out suggesting that when JobSeeker and JobKeeper end, the market's going to collapse by 20 or 30%. We walked our way towards that 6 months, 5 months, 3 months, 2 months, 1 month, and then it finally happened. JobSeeker and JobKeeper payments ended, but the market didn't pop. In fact, it went the other way. Now, I'm not saying that's exactly what's going to happen here, but it really feels the same way. Like everyone's sort of just waiting and they're hoping that the rates don't go to like 10%, but they're also waiting for the fact that there's so much fear in the system. So should we not do anything? But the reality is smart money is accumulating. They're going out there saying, let's go and pump out all these negative news, all these negative articles. Meanwhile, we'll just continue going and buying. And I can see this on the forefront. And I'm not just making this up. Like we've got clients that are coming back to us after purchasing 3 or 4 properties. We've got people that are reaching out that already have 10 plus properties and saying,
well, I want to level up. I want to buy now. And nobody really wants to be buying when we are wanting to buy.
So it's like a contrarian way to view these things, and that's where usually you can make a lot of money. But let's go back to the numbers and stats because you don't care about my feelings. Now this mortgage cliff is really caused by the fact that in the mid 2020s, we had interest rates fall to 0.1%. That's the cash rate from the RBA, but the interest rates had fallen for anywhere between 1.7 to 2.5% for a mortgage. Like it was actually absurd. And so at that time, a lot of people started fixing their rates for 2 years, for 3 years, for 5 years. And of course, as you fixed it for say 5 years, you're probably getting a rate of like 2.7 or 2.8%. But if you're going out there and fixing it for a shorter period of time, it was probably closer to about 1.7 or 1.9%. Now again, those rates do differ from investors to owner occupiers, but you get the gist of it. Now, where it's important is that 2 years later or 3 years later, we're here in today's environment. And today you're getting a mortgage at about 5.5 to 6%. So the mortgage cliff is referring to the fact that you could go from making repayments at 2.5% all the way up to about 5.5 to 6%. That here is the cliff. Now that's the inverted cliff. It's the other way around. If you're effectively looking at how much money you would have to actually spend to keep that same asset. Now, in order for us to understand how bad this could get, let's figure out what the portion of loans are out there and what the health of the Australian mortgage market looks like right now. It's about to get dense. This here is the average interest rates of new home loans. And what we can see is from 2021, we've effectively been in an uptrend and it's going parabolic. So we went from the lows of about 2%, which we got in late 2020 to about mid 2021, and then we've started seeing the increase in rates so quickly going up, and now we're probably at an average of anywhere between 5 and 6%. This all does vary on the type of loan you're going for. So if it's a variable or a fixed, or if you're an investor or an owner occupier, this just tells you that all home loans are basically on the uptrend. Now what we can also see in this graph is that the average new home loan size has actually started plateauing, and in some cases dropping as well. So what I mean by that is when you look at the start of this market, July 2020 2019, as this graph covers, you're probably looking at anywhere between 400 and 500K as the average new home loan size. That pumped all the way at the peak around sort of March 2022 to anywhere between 470,000 all the way up to about 620,000. Now again, there's difference. There's a difference between the green being the first home buyers, then you've got the owner occupiers and investors that were purchasing property that were more expensive. But we've seen a break of this trend, and what we can see is that it's not only just leveling out, it's also consolidating and in some cases declining. In both the first home buyers and the owner occupiers, both markets have started seeing consolidation, whereas with investors, we've seen a bit of a sharp drop off, and now we're starting seeing a bounce as well. When we're looking at numbers between investors and owner occupiers, we can see again that they're both on the downturn. And this is primarily due to the fact that interest rates increased and that caused borrowing capacities to reduce. A combination of that plus the consumer confidence dropping and the fear around this mortgage cliff, as well as interest rates potentially going to the moon, has caused a lot of people to start reeling things in. They're not spending as much money, and we're going to dive into some of those stats as well. This is probably the most telling one, which is home loan commitments, fixed loans versus variable. In the green, you see total fixed rates, and then in the purple, you've got total variable rates. And what you can see is that fixed rates were on the rise up until about mid 2021, with the fixed rates peaking out May 21 all the way through to about Jan 2022. And since then, it's been declining. And that's had an inverse relationship with variable rates. And the main reason for this is as those interest rates have increased, we've seen the increases so much higher on the fixed rates that people are opting to just go for the variable. And that's why we've seen more demand for the variable home loans ever since we've seen the peak in this market. So effectively April 2022, more home loans were being written as variable rates rather than fixed rates. So what does this all mean? Well, for starters, fixed mortgages ending in 2023 make up for 23% of all home loans. So yes, it is quite a drastic number because that's about a quarter of all of the home loans ending this year are going to be affected in some way or another with interest rates having moved up over the last couple of years. Now, if you think about investors for a second, they've gone out there and been enjoying, the lower interest rates, but in the same time, we've seen rents go through the roof because of the rental crisis. And what they've really seen is their positive cash flow properties turn even further positive. And I'm sure a lot of investors were sitting there and saying, well, interest rates are higher and they keep moving higher. At some point, I'm going to need a buffer. So what they would have been doing is they would have been saving every single month. And their positive cash flow would have turned from about $3,000 a year all the way up to about $12,000 a year because of the rental growth as well as those interest rates remaining so low. So for the investors, I'm not so worried. They pretty much can take care of themselves. As those interest rates have gone up, the rents have also gone up. So effectively they cancel each other out or thereabouts. In the meantime, you've got the owner occupiers. This is where I get the most concerned because you usually found first home buyers or owner occupiers get really emotional about their purchase. And so they spend above their means, which is again, how the middle class stay poor. Instead of doing that, we should have probably gone down the path of spending less than what we actually need, or in fact not buy the top, or even better, just invest in a good quality asset. But with this market, you've also seen a couple of positives over the last couple of years. What you've seen is that property values have increased from 2020 to 2022 and 2023. Yes, we've had a bit of a correction, but the prices in some areas are still higher than where they were pre-pandemic. So if they decided that they couldn't make their mortgage repayments, they would just simply sell, and they would still sell at the market rate, not being desperate. They can actually go ahead and make a profit. There's been a lot of income growth that we've averaged out in Australia, a lot more than the decade average we've seen before that. So a lot more people are making more money. And although these owner occupiers that have had fixed loans haven't really experienced the increase in costs, they have been able to stack more cash because their income has actually grown. Not only that, but they're actually saving a lot more because of their income being higher. So in effect, their emergency buffers should be quite high. And we're already seeing that with a lot of the stats coming out from the ABS as well as APRA. So let's summarize what we just know. We know that fixed mortgages were really popular when interest rates were super low, but a majority of the loans that came after that were all pretty much variable. So we're all experiencing the same ebbs and flows. And we've been experiencing this for the last 10 months. Interest rates have been moving up for a better part of the year, but we're probably close to the end. I suspect we're not increasing any more in terms of our interest rates at the RBA. If you're interested in my predictions of when rate cuts will happen, you should definitely go check out this video. It was basically a month-by-month play. So far, we're 2 from 2, and I think we're about to get Feb right as well. So with the economy all slowing down, and we know that a lot of people are aware that they're going to come off the fixed loans onto variable, their monthly repayments go through the roof. That means these people are having to save a lot more. They can't go out there and, put that money towards consumption. This is actually a really good thing. So the fact that this mortgage cliff is being determined as very dramatic and is going to be the worst thing ever, it's actually going to be quite good for the economy, because out of the 23%, yeah, there's going to be a small percentage that are going to get affected by this, and they probably will get some sort of support from the bank when it comes to hardships, as well as managing their loans, whether it's going out there and getting interest only terms, just to get them to survive during this period. But again, this number is really small. In addition to that, the RBA wants to see a slowdown in the economy. How do you best do this? Well, a lot of people are going to go from having to pay $2,000 in mortgage repayments to about $4,000 or $5,000. That naturally will start slowing the economy even further. And that is why I've come out on the channel and said, I think the risk is more about deflation and a recession in 2023 rather than interest rates going straight to the moon, because that would actually crumble the entire economy. I have expectations that the rates will start cutting towards Q3 of 2023, which means effectively many people that actually fixed their rates in 2022 or late 2021 may not actually have to experience rates that are currently in place. They may come in and at that point, maybe rates have gone down by 50 to 60 basis points, which means again, they aren't paying premium, which is 5.5% or 6%. Mortgage rates could be down as low as 4.5% to 5% by the time they actually come off, which isn't going to be so bad. And again, is why I always encourage for you guys to not only smash that like button, but also use critical thinking. When you see these dramatic headlines, really understand the logic behind it, the numbers that are actually coming out, and then accordingly, you can make your decision. I know this has been a lengthy video, but I really wanted to pack some value in and really show you that it's not just me trying to guess my way out of, whatever this looks like in terms of the housing market. We really have an opportunity to go out, buy underpriced real estate, and then be able to grow our wealth towards financial freedom. If you need the help, definitely contact me. There's a few free sessions available, so definitely go check out the links in the description below, as well as email me, which is pinned in the comments down below. I hope you guys have enjoyed this, and I'll catch you guys in the next one. Thanks, guys.